Well, greetings everyone, and welcome to the June session of the Roundtable entitled Brexit Schmexit. I'm joined here by my colleagues Ken Kavula of Mid-Michigan, Cy Lynch of Atlanta, Hugh McManus of, well, it was Pasadena. Are you still technically Pasadena, Hugh?
Well, I'm in Azusa, AZ-USA. Yeah,
Well, that's close.
it is very close. Yeah,
Out there in the burning
yeah,
tundra.
the fiery mountains.
And my name is Mark Robertson, and again, all of us have been together as investors in investment clubs and in the investment club community for a number of years. And the entire purpose of what we do here for this session is to talk about perhaps some common themes, some current themes, and share some ideas. That's the whole purpose of our next 75 minutes together. If you have any slides or questions and answers that you'd like to seek, that's my email address in the middle of the title block at the bottom, markr@manifestinvesting.com. If you'd like to be added to a reminder list, or if you have a friend that would like to be reminded about these monthly sessions, we do hold them now 90% of the time on the final final Tuesday of every month. So you can kind of dial into that. We do record the sessions and make them available both at the Manifest Investing website, the public portion of the site under events, and then they're also available at YouTube under the Manifest Investing channel or whatever they call it over there. So they are there. Let's go ahead and get underway. Here's the disclaimer. No investment recommendation is intended. This is all about demonstrating. 90% of what we do at Manifest Investing and Better Investing is to take a philosophy and a process that's basically over 70 years old now and demonstrate it. Show it through illustration and through case studies, talk about real companies in real time, hence the disclaimer, please do your homework. And we could actually be talking about stocks that we actually own in our own portfolios in some cases. Here's our standing agenda. We'll take a look at how we've done over the last 6 years. We are coming up on 6 years, 6.0 years, guys. So we've been doing this every month for a while now. So thank you. We'll take a look at the results of those 6 years for a few minutes. We are going to talk briefly about a continuation of our better selling discussion. Not a whole lot. We don't have a whole lot of time to dedicate to it. We're going to continue to explore that, looking deeper into some case studies and share those results with all of you as we go. There's the 4 stocks that will be presented tonight. I believe most of those are repeat selections with the exception of Robert Half that Ken will be bringing. And we will poll the audience and then try to leave the floor open for some questions and answers. So real quickly, just a quick reminder, we come here, we do this to basically share ideas, demonstrate a process, try to bring an investment opportunity that would be at the fairly high at the top of a queue of stocks that any one of the 4 of us would study and probably anybody out there within the long-term investing community would take a look at. We do permit some playful selections. Hugh comes up with a few of those every once in a while. Mine usually crash and burn, so I try to avoid them. Ken talked me up straight and parallel a while back, and I've kind of stuck to it, and it's actually done pretty well for me. We do try to beat the market. We keep a tracking portfolio. We want to beat the Wilshire 5000 by 5 percentage points. That's 500 basis points, if you speak that language. And we would like to beat the market and have the selections outperform the Wilshire 5000 a majority of the time. Here's a look at our results through yesterday's close. And the market has taken a beating here over the last couple of days with what's going on in the United Kingdom and Europe. And you can see that our rate of return has dipped a little bit down to 10.2%. But again, that's 2.5 percentage points better than the market. Our objective over the long term is to try to get a relative return. In other words, beat the market by 5 percentage points. That would be the red dotted line across the top there. That's what we're aiming at. Hope to get there someday. And you can see that we have picked selections that have outperformed the Wilshire 5000 a little over 50% of the time. So we're headed in the right direction, and that actually is fairly decent performance for a fairly large collection of stocks over the last 6 years. Any questions or comments, Ken?
No, we're clear at the moment, Mark, so we can keep moving forward.
All right, here's a quick look at the major contributors to the portfolio. That's a public link at the top of the page, so manifestinvesting.com/dashboards/public/round-table will get you to the Actually, we'll take a look at it here in a second and show it to you, but these are the ones that have been selected a number of times and basically are the biggest constituents of performance in the portfolio. For example, Cognizant Technology has been selected 12 times. Every time a company is selected, we invest $1,000 into it. That's whether we do that, whether the selection comes from a knight, a guest damsel, a guest knight, or the audience. So anytime it is selected or a decision is made, we invest $1,000. So in the case of Cognizant, that's been done 12 times. $12,000 is now worth, as you can see here in the middle, $17,000. And you could basically take that same argument all the way down to the bottom of the page. I'll go ahead and jump out here and show you what it actually looks like live. So again, if you go into the public dashboard, if you were to type that in, you can actually see this legend up at the top shows you how many times the selection has been made. In the case of Cognizant, it is 12 times. And you can see the 17,327 there. So you can just kind of look down the list. For example, Qualcomm has been selected 9 times. Apple's been selected 8 times. So you can see that Apple's $8,000 has grown to be $10,400, and we've taken a pretty good hit in Apple here in recent days, along with everybody else. But you can see the major contributors to the performance of the portfolio. Now, one of the things Cy likes to do is basically sort by the projected annual return and begin hunting for companies with high quality ratings and high projected annual returns. So he would basically be doing his shopping amongst these blue excellent companies and looking for companies that would be in basically our equivalent of a buy zone, which would be the sweet spot, these companies that are in the green. So again, you can play with that. You can see, take a look at the number of companies that have been selected over the years. You can play with the, hey, how about that chart, guys? Size diversification, pretty much set up the way we like to see it. Maybe we have a little bit bigger concentration in large than we'd like to see a few more faster growing companies, but that isn't bad. Any questions or comments, Ken?
Well, I just noticed today, I do watch Kramer occasionally, and I watched him today. He was talking about, he was the popularizer of the term FANG for Facebook, Amazon, Netflix, and Google 2 or 3 years ago, you know, and he said those were the stocks to own for those couple of years, and he's added Alta to his list now, and he's come up with a new acronym, and for the life of me I can't remember what the new acronym was that he came up with, but it was just interesting that he added Alta. You don't often see a stock that we've only picked 3 times make that top list that we're showing right here. And in fact, if you look down near the bottom of the list, Alta's on that list down there. It was picked by Susan Michalik once, and then I presented it once, and it was picked by the audience as well. But so that's $3,000 in a relatively short period of time, moving into $4,800. I think Alta is the stock I picked at the Better Investing National Convention. So it's really performed very, very nicely for us in a very short amount of time. The other one that I want to draw to your attention, and it's because I keep hearing the name on the financial channels now. I never used to hear the name Universal Display or references to OLEDs or to the ticker OLED, but Universal Display has suddenly become a darling of some of these people that they bring on to give you the names of 2 or 3 stocks that might be very interesting going forward. That's what you hope to have happen with a small company. You hope that the market will discover it and fall in love with it, but OLED's only been chosen 3 times as well, and it's worth, what's it worth now, $7,000. That's a pretty nice return for those 3 choices. So
you and I picked it together one night, coming at it from different directions, and the audience selected. So that is the 3 times that it was selected. So yeah, that's wow.
Yeah, so those 2, Mark knows that I've been kind of watching this top of this list and looking for ones that have only been picked 2 or 3 times, and then you know, kicking myself for not picking it again and again in a couple of the next couple of months. But at the same time, looking at stocks that have really, really outperformed for us in a terribly good way. So I'm very happy with those two, and there's a number of other really good picks on this top list as well.
Yeah, there's another one there that's only been selected, I believe, twice, and it's Amazon. And Hugh got some grief from the audience for Amazon, and you can see that it's almost up to 5,000. That's even with some downward pressure here in the last few days. So Amazon continues to be quite dominant, and it's, as you were saying earlier, Ken, it's mentioned quite frequently. Any current thoughts on Amazon, Hugh? Any changes in opinion?
Well, the thing I've always loved about Amazon, recently at least, I was very scared of it when it was a new company, but the thing I loved about Amazon was the fact that it was putting its money into improving its infrastructure. So while it's in a dominant state right now in this market, for the foreseeable future, I don't see how anyone can catch up with it. And I think people say it owns 5% of the retail market. I think it's much lower than that. I think it's 2 or 3% at most, but it is growing, and you can see it's leaving people in the dust. Walmart finally has figured out a way to catch up a little bit, but I just kind of bemoan the fact that the thing that's hurting small businesses isn't Walmart. It seems to be Amazon. You see all of these for rent signs in LA County in these small strip malls. They're hurting, you know.
Mm-hmm.
And I have to say, I'm a customer of Amazon, both with groceries and everything else. And it's not surprising that there has not been a new mall built in the U.S. This is one of the classic malls with 3 or 4 anchor stores. There hasn't been a new mall built in the U.S. since 2008. And everyone, remember, for the last 2 decades has been arguing that there's overbuilding in retail in the U.S. and it was twice as much per capita as the next nearest country. And I always believed that, but it didn't really seem to affect anything. Now it seems that it's beginning to hurt, and you're seeing strip malls suffer.
Now, the one caveat we should offer the audience, and then we'll go to you, Ken, is that you can't do earnings and price-to-earnings ratio on Amazon yet. And that's what drives most of the investing and the professional analyst community. We refer to them as rhinos. It drives them crazy. And you listen in on some of the stuff that when Jeff Bezos is online, he's not in it for the earnings yet. And his answer to the question, why don't you have any earnings, is what type of earnings would make you happy? Do you want $8? I can give you $8.
Yeah.
Just have to
it'll be about
stuff.
5 years. It'll become a classic NAIC/Better Investing company.
I know. So you have to think of it as early stage investing, and you can actually look at some of the stuff that he was posted, and we've done actually a mini workshop on how you have to look at the company differently. You basically have to look at cash flow. That's what they're managing the company to. Ken, what was on your mind here?
I just think that when the name of your company or one of your products becomes a noun or a verb, I think that's a really a good indicator of great things to come for that product and or that company. And when people talk about shopping from Amazon, I think they're talking about a lot more than just shopping from Amazon anymore. I think that's being used in reference to shopping online a lot today. They're Amazoning it, and other retailers are being Amazoned, driven out of business, basically. So.
All right, I think we probably better go ahead and spend just a few minutes on the selling guidelines. I'll kick us off and see if we can't just have a brief discussion of a few things. Again, we're talking about conventional, traditional selling guided by the same types of things that we have always looked at Better Investing and Manifest Investing. We do think that the portfolio should be at the center of the decision. We manage our portfolios to have enough expected return or return forecast in combination with quality and growth, and basically how that all kind of puts together as a puzzle is part of that decision. So any stock with a weakness in one of those areas could be a candidate for sale. You can't have a company that actually is going through quality degradation. That alone, with the wheels coming off, can be a reason to sell. And again, you can have a situation where a company, even a blue chip company, like we're going to talk about WD-40 a little bit. It's a company that probably is overvalued at this point, maybe by as much as 40 or 50%. Good company, great company. But again, the return forecast is sufficiently low that it could be a candidate for a sale on that purpose alone. So again, depending on the company that you're looking at, whether it's core versus non-core, might actually influence the way you look at it. And then this fourth bullet that we've come up with over the last few months, and again, we're still scratching our heads. We don't know where this is going to go, but this concept of possibly using relative return as an alert or a trigger. We've actually done that with a few of the stocks in the portfolio, and I'm very comfortable with the ones where we've done it, like Iconics Brands. Great story that I had a couple of years ago. It just didn't work out, and we literally were stopped out of Iconics Brands. And I also had an energy services company that I can't remember which one it was. It was one of the platform companies that actually got stopped out with the carnage that's going on in the energy sector. So we're basically looking at, should we consider the use of a relative return? And again, this is all inspired by thinking along the Investor's Business Daily line of Bill O'Neill and his 7 or 8% absolute stop that he puts on any new purchase. Again, that's not, we think the relative, if the stock market went down 10% and your stock went down 5%, you're actually doing pretty good. So we think that the relative, comparing how stock compares to the stock market performance is an important aspect of this. And we actually put together a chart tonight which takes a look at how some of the stocks over the last year have done, some of the selections that have been made. You can see the actual individual decisions along with the purchase date, the current price, that's either tonight's close or yesterday's close. And you can see that some of these are down in that 20% range. We think 20% might be the point where we actually start giving some thought to should we stop out of the company. Like I said before, I'm very comfortable with the Iconics brand situation and walking away from it. In last month, I nominated Nordstrom. I'd have the same thought. If I saw Nordstrom at the top of this list at minus 20, I would say walk away and come back again some other day. But how do you guys feel about, some of the companies you're seeing at the top of this list?
Well, I like the discussion, Mark, that you and I had, I don't know, 2 or 3 weeks ago, where we were kind of pondering, is there a number? Is there a certain number that when the relative return reaches that number, you should sell for capital preservation? And I like the discussion when we brought in the idea that quality might be a factor in selling or not, and that the size of the company might be a factor in selling or not. I mean, this list has a pretty good jolt of small companies on it. And I'm thinking to myself that, we buy them with the full realization that they might be extremely volatile. And if they're of high quality and they're still going to exhibit that volatility, I'm not sure that that number should be really low to stop us out of it. Now, I'm concerned when that number, moves up into the 20, 21, 25% range. But when you have a lot of companies that are on the small side, I think you're going to find sometimes these large swings relative to the market. I also would want to consider this as a trigger to generate a debate about a stock. I'm not sure that I'd want to move to some of these things just automatically. I still would want to take a good hard look at the company and make a decision about whether or not it's company specific, or is the industry in trouble, or do we have a certain commodity that's causing the problem across a number of industries. So I think there's a lot to add to this discussion, but I would like us to seriously consider maybe a number that varies based on the quality of the company, the size of the company, the price stability of the company, and maybe have a series of 2 or 3, not more than 3, but simple rules if we're going to set this kind of process up.
Yeah, Hugh, you had mentioned false positive. We'll go to you in a second, Si. You had mentioned the false positive type nature of testing this. Can you kind of give your thoughts on that?
Yeah, I'm well aware that, say, one of the things in the stock selection guide is that the fundamentals of a company start to deteriorate. It often looks better on an SSG. Or if it's a cyclical company and you're just looking at PE ratios, you may be coaxed into buying the company at precisely the wrong time. And I was just thinking through the day today, is there any way that this approach could give a false signal? And I started the day thinking, oh yeah, I'm going to find oodles of them. And the more I thought about it, the more I wondered, is there a way? Because, I mean, it's looking how the company is behaving relative to the market overall. And as Kenneth pointed out, might be more accurate to look within an industry to see how well it's doing. And in that light, Staples, say, doesn't hold up well against one of its competitors, which would be Amazon. Amazon is a factor in the current demise of Staples.
Oh,
I thought it would be backstopped a little bit by virtue of the fact that it has a very strong, talking about Staples, a very strong online presence, maybe the third biggest in the country, but it's suffering badly, and it's suffering because it has a physical footprint that's extremely large and needs to do something about that. Merging could have helped, could have given it some cover to hack generously through the Office Depot and Staples footprint stores, but that doesn't look like it's going to happen.
What are your thoughts on the concept side?
Well, I am certainly price drops, and I would prefer relative price drops, as in relative return to an absolute, are certainly indicative of a company that's headed in the wrong direction. I don't think any of us have ever had a company's value go to zero that it didn't have a horrible relative return at some point.
Mm-hmm.
So there's 100% correlation there. My problem is, what is magic, or a problem is, what is magic about our purchase date? And this chart is perfect for proving this.
Mm-hmm.
Biogen, in the time that Ken and I picked it along with the audience last January, notice is bumping up against this possible 20%. So now that's a questionable buy, but notice in March I bought it, it's only at 7.9. But it's the same company at the same value today.
Right.
So is it approaching a sell, or is it not approaching a sell? And I think that, and I have many of the same considerations that Ken mentioned. I mean, Cognizant Technologies is another great example. That industry, the IT outsourcing industry, was beaten up for a while. I mean, everybody was killed. And yet that was a buying opportunity, again, just about across the board in the leading, rather than if you had just looked simply at the return. And I don't know if the relative return would have approached anywhere like 20%. So I'm just talking anecdotally off the top of my head. Statistically, it might not have approached that. But again, I think you can have an industry running the wrong way, but you buy good companies in that industry, you may need to be patient, but you shouldn't be selling.
Right, and I think we experienced that. You know, couple notes I should make here. You know, we went back and we did this analysis on the Solomon Select portfolio. You know, granted, it's only 12 picks a year for 12 years, so it's basically about 140 data points. And Charles Bard pointed out that, you know, that might not be enough information yet. So we're going to do further case studies. I only found one case of kind of a false positive where what he was talking about, where we would have been stopped out of Oracle and probably missed about a 600% gain. And I think that's kind of what you're talking about on the Cognizant. The other thing that
Right.
I was mentioning here is, in my opinion, right now, Illumina and Polaris are screaming buys. And it just doesn't give me the same mode of, and for that matter, Apple, I don't think is anything, there's nothing wrong with those first 5 entries on the chart at all right now. And, you know, I think Ken's thought about, I think we need more dimensions. He actually brought up the notion of, should the price stability be a factor? I mean, that's obviously going to be related to the EPS stability, but the quality of the company, and you guys are bringing another dimension with the industry. I'm with you on that. You know, as far as companies on this list that I would have any concerns, I think IPG is a little bit frisky. I think Buffalo Wild Wings, by virtue of being a retailer, could fit this description of, you know, being more more useful to stop out of something like that. So again, some of what I put together for tonight is here's a look at Illumina. You know, again, put it on the hot seat. You can see that the stock price has drifted down over the last several months. But again, I see a company that has outstanding quality that's actually has a higher return forecast down here. And I don't think it's a mirage in the case of Illumina. So, I mean, I would have a real hard time stopping out of this one. I think the quality of the company ought to influence. I don't think that 20% is cast in concrete. I think it's got to somehow reflect the quality of the company and maybe some other variables.
And maybe you just hit on one, Mark. Might the proper, and I'm trying to figure out, simply relative future return would not be sufficient. But should you be looking, should we somehow have a future dimension to this?
Mm-hmm.
In other words, a company that is falling in price and yet its return relative to the market, future return, is staying flat or, heaven forbid, going down.
Absolutely.
That to me is more of a sell trigger than looking at a historical return.
Mm-hmm. Yeah, I think that one, that hits it on the head too a little bit.
Mark, we're getting I'm sorry, go on, Cy.
I was going to say, so maybe some sort of a combination of the price going down, but the future return relative to the market not going up commensurate to the price drop.
Yeah, that's a really nasty situation when you see it. We don't have it in tonight's example at all.
Right.
And here's Polaris, same situation where the company has dipped in price. And I was telling Ken earlier tonight, if I was actually holding Polaris, I see it as a buy. And in fact, a few months from now, if I was looking at our situation, I would probably be looking at tax-related selling, tax loss selling. In the case of Polaris, hoping to sell it and buy it back, you know, based on our perceptions of, what the company might have going forward. Again, we're looking at an extremely excellent quality company that is reflecting higher return forecasts as the price came down. Now, if I saw a declining return forecast with the price going down, I'm with you 100% side. That's a danger Will Robinson moment if there ever was one.
Mark, we're getting a comment from Len from Southeastern Michigan chapter,
Mm-hmm.
And Len is making the same point that we made in this discussion last month, that we also wanted to look at stocks where the relative return has fallen from a place where you had made some good capital gains. And in this discussion that Mark and I had, Len, 3 or 4 weeks ago, I think we decided that we were really looking at two different questions. One question was relatively short term within the first year that you bought it, and that was focusing on capital
Preservation.
Capital preservation. Thank you, Mark. But the other thing that we're looking at was when a company that had been doing really, really well for you and then suddenly started to lag the market significantly. That's more capital gains preservation, and that might happen after 4 or 5 or 12 or 14 years.
I really
and
like that.
there certainly needs to be a trigger for that as well, but we haven't even gotten the first one worked out yet, but you're absolutely right. When a company where you've made a lot of capital gains starts giving all those gains back, you need something to trigger that potential as well. I was talking with Ann Cuniaz about this situation earlier today, and she and I both agreed that too often, especially in a better investing portfolio, a stock that has performed really well for you in past history, a lot of times it gets ignored even though it's creeping downward rather than upward for the last year and a half or whatever, because we don't tend to chart prices. We don't tend to keep as close an eye on price as sometimes maybe we need to in relation to what the market's doing.
Yeah, and I think Len had a good recommendation. If we're talking about the capital gains preservation mode, the work that we did on Apple a few years back, where we talked about trailing stop limit orders, TSLOs. I mean, I think that there's a possible correlation or connection to that, and it could tie in real nicely with this notion of what are the dimensions, the price stability, the quality of the company, um, all of the stuff that we know is important, and there probably is a way to derive a guideline for something like that to protect. Again, Ken, I really like this notion of the first 9 to 12 months, because that's what we saw with the Solomon Select portfolio. A lot of times, if the wheels were going to come off, they were going to come off in that first 9 months, and that's exactly what you saw in that previous chart. Those are all holdings that are less than a year old, and again, history going back over 6 years, and again with 12 years with the Solomon Select portfolio, we saw that time and time again where the companies that fell apart in the first 9 to 12 months were the ones that really inflicted the most damage on the portfolio. So I think it is a credible and a reasonable thing to watch in that formative period. Again, preservation of capital, but I think you guys are both onto something with switching to a different mode of a capital gains preservation also. A really strong theme. I think we can leave this where we've got it right now. I'm going to actually go through an analysis that's very similar to what I did with the Solomon Select tracking portfolio for the round table, and basically go looking for those situations where we did get false positives over time, and obviously it's going to be a much larger data set, and we'll take a look at what happens to that, with some type of guidelines in place, and try to go down that dimensional path a little bit here in the future. So with that, I think we'll go ahead and switch into the stocks part of the program. Ken would like to dig into Robert Half tonight.
Okay, well,
company.
Let me tell you what I was looking for in a stock for tonight. I wanted to find a stock that was trading at what I considered a deep discount to where it had been trading recently. In other words, I wanted to take advantage of this Brexit dip over the last couple of days, although the market was up today. I also wanted a stock, if I was going to dive into something that was trading at a deep discount, I wanted to find a stock that had stellar finances behind it. I wanted it to have a nice balance sheet. I wanted it to have a nice stash of cash. And I wanted it to demonstrate that it could handle the debt that it had, or even better, that it was carrying little or no debt, so that it was going to stay kind of nimble going forward. I also wanted to find a company that wasn't intent on acquiring its way to prosperity. So I was looking for a company that did a lot of organic growing in history, and I was counting on the company. If it did a lot of growth organically in history, I was hoping that it would stay, the growth would continue in that manner. So I came up with Robert Half, and I'll admit it was a company I didn't know much about. So let's click through a couple of slides. Some of these first slides come directly from the investor webpage, and I'm not going to read this to you, but this gives you a little bit of an idea of the history of the company. That last bullet point, around 2002, the government suggested via law that auditors could not run branches of their auditing firm that were consulting with the companies they were auditing. So all of the major auditors had big consulting branches at that point, and they got rid of those consulting branches, either spun them off as independent companies or sold them off. And this was one of the few times that Robert Half made an acquisition. They bought the employees, about 200 employees from Arthur Andersen, and they created this Prodaviti division, which basically was doing the same thing that the Arthur Andersen consulting arm was doing, very high margin business, and a business that is growing much more quickly than the temporary staffing business. Click again, Mark, or a new slide, please. I know that with Brexit so much on our minds, one of the first questions would be how much of Robert Half's business is done outside the United States? Well, less than 20% is outside the U.S. They operate in 400 offices located in 22 different countries, and you can see that 81% of that operation is right in the U.S. Click again, Mark. And if you take that 19% and you break it down, then you get only 3% in United Kingdom, in Britain. You do get 10% in continental Europe, and continental Europe is probably going to stay a basket case until this whole issue of who's in and who's out and how are they going to make it happen at least has some clarity going forward. But it's not a huge part of their business. It is a significant part of their business, but it's not an overwhelming part of their business. Click again, Mark. Their revenues basically come in 3 different divisions, and the company is essentially split into 3 divisions. They can provide permanent placement services, sort of like headhunter services. That's 8% of their business. 78% of their business is temporary placements, and they place in really highly skilled jobs. These are not the temps that you would hire if you needed a low skill temporary worker. These are highly skilled, highly trained people that they're placing in these temporary positions. Many of them move into permanent positions. Robert Half provides those as the months go by. And then 14% of their business is this former Arthur Andersen consulting called Prodaviti. It's risk consulting and internal auditing. Click again. Where it says RH, that's the traditional temp business. Where it says Prodaviti, that's the business with the most highly skilled people and the highest margins. And right there in the middle, there's another TCG company, another logo right there in the middle, and that's the permanent placement business, and that's margins that are higher than temporary placement, but not as high as the Prodaviti. Click again, please. If we're looking at temporary placement in the financial sector, that's one of the highest growing jobs, and it's expected to outpace the national job growth averages for the next decade, starting in 2014 and going through 2024. Accountants and auditors, top 15 occupations during that same 10-year period, and they have low unemployment rates. These unemployment rates are coming from the year 2015, but you can see that those are relatively low unemployment rates compared to the overall unemployment rate that's been going into the market, which still might hover around 5%. Click again. IT marketing, and these are the other temporary placements they're making. That's 3 to 4 times larger than accounting temp marketing. Again, very low unemployment for IT positions, so that's a growth driver for the company. People are hard to find, and when you can't find somebody and you need somebody to fill a spot, you'll go to a temp agency like Robert Half, and you'll hire a temp for a period of time. And then new application development demand at the middle market companies. Robert Half likes to focus on medium-sized companies. These are the companies that can't afford to have a full-time person in a job that's only half-time, and so they're much more likely to put a temp person in a half-time or a 2/3 time position if they can't find somebody to hire on a regular basis. Click again. I like a company with a lot of cash, and this is a lot of cash, $214 million in cash, relatively small, medium-sized company, so that's a lot of cash for a company this size. This is as of March 31st. Total assets of about $2 billion and virtually no debt. This was one of the things I was insisting on as I looked for a company. I wanted a good, solid cash and debt position for this company selling at a discount. Click again. They also pay a significant dividend, up around 2.5%, 3%, depending on where the stock is trading. That's a nice dividend in today's market. It's significant that you'll get that payment through good times and not so good times. Click again. This is just a number of points that they make in their presentation, and you can read as well as I can. That fourth bullet, the long-term demographics point to the fact that in the fields that Robert Half staffs in, there's a huge war going on for talent right now, and they anticipate that that war is going to continue and get even nastier and more severe company to company. Again, that's a good growth driver for this company. Click again. That PCAOB audit inspections, that came with Sarbanes-Oxley, and down there beneath the main box, I've told you what the acronym stands for. It's the Public Company Accounting Oversight Board, and basically they come in and they'll look at the accounting that's going on in public companies. They're a non-government agency, but they were established by law, by Sarbanes-Oxley. So these kind of things are important to medium-sized companies. They want to do well when this audit inspection comes to town, and they'll be hiring temporary people to help them do well when they're informed that this is going to happen. Click again. Here's the lines. Obviously, during a recession, all the companies in this industry, and if you were to look at the graphs of most of the competitors for this company, and we're going to do that in just a moment, you'll notice that they took a beating during the recession, but they've managed to have good, solid, strong growth coming back. Notice the distances shortening or getting smaller between the green line and the pink line. That means they're cutting their expenses and or raising their margins, and a lot of this has to come from rising margins, and as the margins go up, the distance between the green and the pink line shrinks. Click again, Mark. I chose 7% growth for historical sales, and then I used a good classic preferred procedure and came up with 7.5% growth for earnings. I did some research. Those are really conservative numbers. They're significantly conservative. Notice that the pre-tax profit on sales is moved up significantly. That's the distance between the green line and the pink line, and you can see them moving up in the numbers on that first line there. A return on equity, a good solid number, and it's a clean number because this company is carrying virtually no debt. So when you're doing return on equity, you know, up above 25-30%, you're really moving in a really nice rarefied air, and you're really helping your stockholders in the process. Click again, Mark. The range for growth, I'm just showing you what the historical growth has been. Over a 5-year period, that sales growth was at 9% on that graph. In the last 2 years, the sales growth has been 9% again, so I think choosing 7 puts it in a really good position. I did raise the pre-tax profit margin to around 10.5 to reflect the fact that the margins are increasing as we go forward in time. And this company has a healthy stock buyback program, so I did lower the stock share count to 120 from 130 over the next 5 years because the company indicates that the stock buyback program is not close to being finished yet. Click again. Here we are evaluating management, and I'm just made that bigger for you to take a look at. Again, I'm comfortable with the numbers that are going on here and my 7% and 7.5% growth. I think an excellent balance sheet. Click again, please, Mark. Here I'm showing you the comparison in sales, and if you look, Robert Half is the kind of dark green line right there, and there's only one company that's probably compared to Robert Half's growth right now. That's the blue line, and that's I'm not reading the ticker correctly there. Can somebody read that for me?
TBI.
TBI, thank you. Okay, so TBI compares pretty nicely in sales. Click again, Mark. Robert Half has now changed to the dark blue line. That's the one at the top. And TBI is now the purple line. So again, TBI looks to compare pretty closely as far as earnings are concerned. Click again, Mark. But when we get to margin to pre-tax profit, Robert Half is now the black line, TBI the dark blue line. You can see that Robert Half puts the other three companies to shame. The other two companies are Kelly Services and a European company, HSR, which is having some real issues right now with all the problems going on in Europe. Click again. Here's Robert Half's return on equity. That's the black line this time. TBI is the purple line. And again, Robert Half is outpacing the competition. Click again, Mark. And here's debt levels, and here's where you want the lines to be down at the bottom and nice and flat. And until a couple of years ago, TBI was carrying virtually no debt as well, but you can notice that TBI is now carrying a significant amount of debt compared to Robert Half. Robert Half, the black line, TBI, the purple line. Click again. I noticed that it was trading at the same price that it's for a low this year. It's practically at its low price. This was as of Tuesday night.
He was calling.
I'm sorry, as of Monday night. So this is the kind of stock that Hugh takes a look at sometimes. And I was really pleased to see that current PE about 60% of the historical 5-year average PE. It's trading for a PE of a little bit more than 12 right now. Click again. I don't normally select a low price. I just use my average low PE times my estimated low earnings. I come up with a forecast low price. That's 4BA, and that number usually works for me. But 5-10% of the time, I'm going to have to select a low price, and here's a time when I did, and I went down to $28 and put it in the buy zone. Click again. Current yield 2.5%. I'll take a 2.5% yielder anytime, although I'm not looking for a dividend. When it gives me a nice healthy dividend, that's great. The average anticipated yield going forward is about 2% a year. So 18% stock price appreciation, 2% from the dividend, about 20%. Click again. I love the Chronicle, and here's a company that's had a great quality rating. That's the blue line for a long time, with an anticipated par value from Manifest of 16. That's at the top right of this slide. If I were to take that red line and put a dot on 16, I'd be practically at a historic high return for this company. So I'm very pleased to buy companies with high quality that have a historic par value moving forward. Click again. Here's Mark's study just right from the website. He chose a share count of 128 and a PE ratio of about 17. Click again, Mark. I looked at Value Line, noticed that the return projections were pretty nice, 19% at the high, 11 at the low, but that was at a price of $45. The price is at about $32, so that would increase those return numbers quite a bit. I kept that in mind as I was doing my SSG. Here's average annual PE ratios, and they were a little bit higher than the analyst choice of 17 that Mark has in his particular study. So I kept in mind that, value lines at 19, 20, 21. And I did look at the annual rates, and they were growing revenues at 8%, not 7, and they were growing earnings at 11%, not 7.5. So I think I have a pretty conservative SSG with some pretty nice results. Click once more. I did change the shares. I dropped them to 120 on this study, and I raised the PE one notch to 18, and that gave me a number very close to my classic SSG, a par value of 22. I'll take it. Click again. And I think that closes this particular stock presentation then. So I'm going to add Robert Half to the portfolio for the roundtable.
Well, thanks, Ken. I actually have some personal experience with this company. They helped me out back in 1992. I was extremely impressed with them and their outplacement and that kind of stuff. And they're one of the top firms in their line of work, no doubt about it. So we'll go ahead and add them to the portfolio. Interesting looking company. Well, this morning Morningstar comes out with every day they send me an email where they name companies that are new to the 5-star alert. It's usually a company that's had a bit of a dip in price, and with what's going on here in the last few days, well, the list is usually 1 to 3 companies in the morning. This morning we saw 20. So I stuck them on a dashboard, and you can see from top to bottom there's some fairly interesting names that might be worthy of study. And interestingly enough, Endo Pharmaceutical at the very top of the chart went up 18% today. 18%. So you'll see $118 if you go and check this tracking dashboard down here at the bottom. The average stock actually went up almost 4% on this list today. So, most of these are at $104, Endo's at $118. The only one that really grabbed my attention up at the top was Perrigo, and that was actually the 20th worst performing stock out of the 20 today. But Perrigo is definitely a good long-term study. Just some interesting names on here. Perrigo is a good study. So is Williams-Sonoma. I mean, you can see the quality ratings over here, kind of what draw our attention, along with the elevated return forecasts. The automotive companies have all taken a hit with what's going on over in Europe. And along with some special challenges to people like Volkswagen. I'm kind of surprised Hugh hasn't been sniffing around Volkswagen with all the trouble they've had with their emissions controversy. That's a real calamity, but a number of companies, Kingfisher is the British Home Depot, by the way. It might be interesting to take a look and see how badly they've been hit. But again, some fairly interesting studies on here. Nothing really jumped off the page, but I did want to add Norwegian Cruise Lines in honor of our Alaskan cruise in September. That has been added to the Value Line Standard Edition, and sure enough, the price has dropped quite a bit over the last 6 or 7 weeks, and the returns are elevated now into the mid to upper teens, and actually not a bad study in combination against Royal Caribbean or some of the other cruise lines. But much like Ken, I wanted to go shopping with a theme, and with what's going on in Europe, I actually think what's going on in Europe is kind of similar to the concerns that we had back in 1998. You may remember there were troubles in Russia, troubles in the Far East, Thailand, and some other places. Mexico had some issues. In a nutshell, basically, it was just a real global disruption where there was some tremendous concerns back in 1998, and it reminded me of a good friend of ours going back over the years by the name of Charles Almond. That's him on the right. And at a time when people are kind of sticking their heads in the sand. I don't know if you've seen the commercial. I'm not even sure what company it's for, but all the businessmen with their heads in the sand, then they jerk their heads out and run off a cliff like lemmings. I mean, some of that type of behavior is something that we could see. And Charles Almond was the author of the Growth Stock Outlook. He actually prepared columns for Better Investing for a number of years, got to interface with him directly. And one of my favorite stories about Mr. Almond is back in the 2008 timeframe, he wrote a column for Forbes, How to Pick a Growth Stock. In it, he featured 12 companies back in November 2008. That went on to outperform the market over the next 5 years by 15.7% per year. And the reason that his name came to mind and what I was thinking about here, again, combining a time back in the 1998 time frame when he went for companies like Limited and WD-40 and had a fair amount of cash, but the one company that always kind of intrigued me was a company by the name of MoCon that with the ticker symbol MOCO, a really small company. It's the type of thing that he really liked to get involved with. I think to this day they only have like 60 million in sales some 10 or 20 years later. So it's a relatively small company, but well managed, kind of a Neogen type company, that type of thing. So I kind of went looking for something like that. Here's just a quick fun fact for what Mr. Allman experienced with MoCon. That's a 16% annualized return during a period when the market overall was relatively flat. And again, he just loved the small company. Again, excellent management and probably fairly close to home for him. And again, you don't always have to have those flashy names that are, all over the 24/7 news and the Wall Street Journal. Sometimes the ones flying off the radar screen, like our Neogen and 2-6 out of Pittsburgh, and there are a number of examples from around the country where we discover these type of companies and basically prosper from them somewhat in silence and obscurity. So my selection for this month is going to be go back to a repeat selection, Mesa Labs. Again, no surprise to any of you, or no stranger to many of you. I didn't know that they put out a biological indicators newsletter that goes by the name of Spore News. Might be kind of interesting, but again, this is food safety. They're into dialysis and diabetes type stuff, and again, detection of toxins and bad stuff when it comes to food safety. So they are a lot like Neogen. You can see some of the products are just the swabs and the indicators and the testing vials and all that kind of thing. But again, this is a company relatively small, less than 100 million in sales. Many of us have followed the company for several years now, up straight and parallel. Again, less than 100 million in sales. I look for growth in the mid-teens, 15, 16, 17% is fairly reasonable. Really decent margins, although they are contracting over time, and they did go through a little bit of a disruption when they did some acquisitions here a couple of years ago. They are kind of ferreting through those, but again, fairly decent expectations. We did discover this company back when the average PE ratio was down in this territory. This is when we love to discover them, when they're basically undiscovered by the street, and then benefit as we see PE expansion going up with the demand brought by institutional investors. It doesn't take a lot of institutional investors in a case like Mesa Labs to drive that number up. So again, a really decent growth rate for a well-managed company, fairly steady profit margins over time. PE ratio in the mid-20s leads us to returns in that 12, 13 to 15% range, which again, with a market with returns in the approximately 7% for return forecast right now, this is a really solid company for the long term. And again, we're looking for something that's not necessarily in the crosshairs for all of the European noise, looking for a place to hide a little bit, stick our heads in the sand, but also latch on to a very high quality company. And I think Mesa Labs fits that bill very well. So we'll go ahead and add that to the portfolio. And switch gears back to another repeat selection, one that many of us have tracked with great interest for the last few years, Biogen.
All right, thank you, Mark. You can see here, Biogen is a good classic up straight and parallel, decent margin expansion going on, and the PE ratios have been bouncing around a bit. I think much of what you've seen going on with Biogen in the last year is that in the 2014, 2015 time frame, I think the price got well ahead of itself, and you see that in the price to earnings ratio here. But I actually started out, Mark and Ken both talked about themes. My theme for the night was for the second month in a row, try and find a new company, but I wasn't successful, and I'll let you see why. I did a screen for companies exploring the Solomon database at Manifest Investing. I set my criteria, or the very first screen actually I set quality at 90. I just figured all the noise over Brexit and so forth, let's really tighten up quality. But this screen helps illustrate my process a little better. It's my fairly typical late bear market screen, 80 quality, so I'm looking for excellent quality companies, tightening financial strength a little bit to 90. So looking at top companies, as you can see, about half the companies at the top of this list are already in the roundtable portfolio. The ones that are highlighted would be additions. The ones that are not highlighted are already in the portfolio. So my theme was I'm looking for a new company. Notice Robert Half is on here. So that was one actually I looked at, but I decided I'd leave it for Ken to pick tonight.
No bandwagon here.
That's right. Mark's already mentioned Perigo. I looked long and hard at Perigo. The main reason I ended up choosing not to select it for tonight, and this is just a thought for your own personal studies, their organic growth is only about half of its historic growth. They have been very much a grower by acquisition, and so you've just got to decide how comfortable you feel with their ability to continue to grow through acquisition, or if you think, and there is some potential for accelerated organic growth, but those are the issues you look at Perigo. I just wasn't comfortable enough with those to go with it tonight. So I said, well, I don't like Aaron's for a number of reasons. Franklin Resources, I just wasn't looking for an asset management company, again, given the stage that we are in the market. And Akamai, I'm still suffering a little bit from Chinese flu from some pork that I ate a few years ago. So I decided I wasn't going to go with that one tonight either. Next slide. So I said, well, all right, if I can't find something new, what's out here in Solomon? Mark's already kind of previewed what I like to do, or not in Solomon, already in the portfolio. Here's the portfolio ranked top to bottom, and again, Biogen pops out as a very high quality company with a good solid financial strength, and happens to be a company among these that I have that I both follow and one that I have suggested. So familiarity is also a reason. Many of these companies here, you see there are a number of Air Lease being one that's a high quality, although the financial strength didn't quite meet my criteria. BIIB, if you can get over the Chinese aspect of it, is their proto-lab. So you can see there are some good candidates here, but Biogen was the one that I was most familiar with. So I said, okay, but I noticed that its financial strength, notice it wasn't on the previous slide, is below 90. So I went ahead and just did a second screen just to see if there was anything out there if I loosened my financial strength a little bit down to 80. And again, as you can see here, it's basically the same list we saw before with Biogen and Under Armour added. Maximus also, I guess, jumped into that, were added, but Biogen still is the top. So for all those reasons, I decided we would go with Biogen tonight. Go ahead and go to the next slide, Mark. And here are my judgments. Ken showed you this for Robert Half, and he used the default manifest judgments. This one has been modified to reflect my judgments. I went ahead and tweaked Biogen sales down even lower than my last time that I did it. It had been 8%. I went with 6%, which is actually off of Morningstar. That's significantly less optimistic than Value Line and some of the consensus estimates, but again, we've got a stock that has been slipping some, and there is some concern over its at least current portfolio of drugs, although they seem to have a good pipeline. But I decided to take the less optimistic Morningstar 6% and see how it turned out. Net margin, again, you see a little bit of a drop-off in margin because of primarily pricing pressures in the multiple sclerosis area, potential areas of concern. But that's roughly the 5-year average, so it's not it's just giving up some recent year margin appreciation. It's really not a deterioration of long-term margin. The PE ratio I chose, that's right in the ballpark of historical average as well as the value line projection, so that's not particularly alarming or strange. And notice my projected return moves from the yellow actually down toward the bottom of the sweet spot, but still in the sweet spot. So my pick this month is Biogen.
So we'll go ahead and accumulate a little bit more. That's at the top of the list, but a lot of potential there. All right, so with that, let's go ahead and switch to Bank of America. Hugh's going to come back with a repeat selection. This is one that Hugh has actually been selecting at a number of times over the last 6 years, and they're obviously in the middle of the storm, so take it away, Hugh.
Yeah, they certainly are. I've actually added, just by way of full disclosure, this week, Morgan Stanley, which I haven't added for a while, but I added that to one of my own portfolios. But for this portfolio, I wanted to add back Bank of America since we already own it. So I thought I would add some more. Now look at the SSG. It's not very appealing. There is a discernible decline in sales. My hope is that's something that will be driven around as interest rates start to climb, whenever that is. Who can tell at this point? But low interest rates do not favor banks. And you can see quite clearly the banks, and this one in particular, did not do well during the Great Recession and has not really flourished during a low interest rate environment. But when you break through the numbers, and we'll see the presentation from Bank of America in a moment, all is not lost. We look to the next slide, we can see part 2 of the stock selection guide. A little bit deceptive, things seem to be looking up, but again, it's coming from a very bad basis as this company slowly rebuilds itself. And many of the all of the banks globally for that matter, are in the same position. If you look at part 3, where we're looking at price and PE ratio and so forth, this is just a disaster. The high PE ratio is driven by what happened in 2011. In fact, before that, it was a little bit crazier. Things have started to return to normal, and whatever that means, I have actually, on the next slide, selected a very conservative high PE of 12, but the low PE is still 10. And one of the reasons not to go lower than that was, if you look at the upside-downside ratio, 6.5 to 1, it's a little bit crazy. I thought the PE ratio can go lower and probably will right now and in the coming days, but just leave it at this point because it does put it in the buy zone. And I included something from Manifest Investing, and I believe I sent these slides before saving. If we move on to the next one, and I did. But I put in the balance sheet, income statement of cash flows from Yahoo. I like this approach because you can look at what is happening over 3 years. It's a little bit of a mess still. A bank is really measured in how well it's doing in its liabilities, and its total liabilities, as you can see, have kind of been flat. The money that it takes in becomes a liability, and it generates money on what it lends back out again. And that spread hasn't been too bad. It can pay interest rates less than 0.5%. 0.5% would seem extremely generous, but it's lending mortgages at 4+%, 3 to 4%, high 3%, thereabouts. So it can do quite well in that area. On the next slide, we can see the income statement, and again, things are a little bit flat, but improving if you go right down to the bottom line to look at net income. When you look at how the top line is performing revenue, we already saw that in the first slide when we looked at the stock selection guide, things are languishing. Banks are changing gradually what they do. They're cutting back, they're focusing on offering fewer products. We'll get to that in a second. And finally, if you look at cash flow, and you can see that there was something bizarre happen in 2003 because they had extremely good operating cash flow. You can see there were adjustments made to operating cash flow activities. that really were quite large. Now when you go to the very bottom line and look at the change in cash and cash equivalents, it's relatively stable. Well, the next, I think, 9 slides are taken directly from Bank of America, and this, we can put this up on the website, I'm sure, because I have the PDF for this document. But basically, as any marketing tool does, it paints the company in a great light. It has about over 4,500 what they call financial centers. I used to know those as banks, and it has loads of ATMs. But it has the #1 share in overall deposit, market share overall. In many sectors, it's doing really quite well. You know, I'm not going to bother with some of the accolades that got below. They look very impressive, but everyone can cherry pick those. But the fact that it has 60 million customers and 45 million households is really quite impressive. Moving on to the next slide. You can see here how it has cut back on its financial centers right up at the top. And as you move down, you can see how it's moving towards automation, where things have been driven from 35%. It's an increase of 33 percentage points overall in the last 5 years, in this case, 6 years. The product mix, it is 1,500, and again, a little bit deceptive because it was adding in various different entities, but it's really simplified that dramatically, about 96%. That's a good thing. And on the next slide, which is a little bit busy, you can see how it's doing. This slide is actually quite informative. You can see how it's doing with client balances, with average loans and leases, and total revenues and how they break down. And again, the big thing that I see is how it's pivoting from traditional over-the-counter banking towards mobile and electronic type activities. And there's another slide later that really highlights this point. But what I also find interesting is that while it's cutting its staff down overall, this is the bottom left chart, while it's cutting the numbers of employees that it has, it's actually increasing the number of sales specialists. That kind of harbors well for me, augurs well for the future. And if we move on to the next slide, some more interesting information about credit card, vehicle purchases, residential mortgages, and home equities. And slide 61, again, it's growing well, but slide 61, as we move to the next one, lets you know who these people are. 10 trillion are professionals with 2 family incomes, over 75,000 per head in income, and over 100K in assets, which is not a huge amount when you think of it, but these are the proverbial preferred customers. I actually am in that class thanks to opening an account at Merrill Lynch with the Merrill Edge product, where you actually get free trades. Most of my trades are actually buys, but they're free. I have 100 a month to get. It's quite a nice thing to have. And on slide 6, it engenders loyalty too. Here you can really see the shift over the last while to how its services or how transactions are processed. And you can see the mobile app, which I haven't had the courage to download personally into a phone. I am a Bank of America customer. But that is growing by leaps and bounds. % change year over year from the first quarter of 15 to the first quarter of this year. That's quite a dramatic shift, where as you can see other areas which are person intensive and then presumably are cost intensive, even ATMs, they're dropping. And on the next slide, moving through this is a bit of a gallop. It's just a sales pitch to see how all of these digital activities are interconnected. And in fact, I do have to say, as a customer of Bank of America, that the call center system works quite well. They're answered pretty quickly. On slide 8 of 9, as we wrap up, they're just doing a little bit of a marketing ploy and showing you how this, I'm very tempted actually to download the app on the phone, but how it all works. I've seen people use it. It is very good. You can actually take a photograph of the check and have it deposited that way, which very appealing, but that's been around for a while. I'm just a little sticking about it apparently. And then the final slide from this presentation, which should give you warm and fuzzies about Bank of America, is innovation for the future. And this triggers me to get on Wikipedia and see how all of this could work, biometrics, particularly artificial intelligence, which, if anything, is a method for getting me to lose my temper when they apply it to answering telephone. I think I probably will need some kind of heart medication. I don't know how you can say, agent or operator. so the thing can actually agree with you. But the final slide just commits me to Bank of America for this month. I bought it a number of times for this portfolio in the past. I am a strong believer that these banks will do extremely well once interest rates rise. I don't know when that will happen. It's not surprising that we're suffering 9 years through a great recession, but it will start to improve soon.
Hugh, you'll be happy to hear that there are many folks in the audience that use the mobile app. They think it's wonderful. I don't use Bank of America's mobile app, but I use my credit union's mobile app, and depositing a check with a picture is so easy and so beautiful, very elegant to do.
I know. I'm sitting with 3 or 4 checks, dividend checks that I've received, sitting in the bag with me that I've taken every trip for the last 6 or 8 weeks. Basically, I'm admitting I'm an idiot because I should download the app, photograph things, deposit them, instead of forgetting that I have to walk around the city and find the Bank of America that's deposited.
Well, Hugh, if you want to send you can send your checks to me, and I'd be happy to test out the system.
Oh, well, thank you, Mark.
All right, with that, I think we'll go ahead and open up the floor for Q&A, but first we have to poll. So Ken, do you have a poll ready to go tonight?
I'm getting it ready right now, Mark, and here it goes. Are you seeing it, Mark?
I never get to see it. Ask somebody else.
I haven't seen it yet.
I am not.
Here we go.
There
Here
it
we
is.
go.
There it is. Now I see it.
I had to press the launch button, guys.
Operator?
Folks, if you're on a laptop or a desktop, you just use your mouse or your touchpad and you can choose one of these stocks or none of them to add to the portfolio. If you're listening to us on a different platform, some of the platforms will allow you to vote and some of them will not allow you to vote. So we're going to kind of wait till we get about maybe 80% voting here. Oh, we just jumped way over 80, so I'm going to give you about 4 more seconds. If you haven't pressed the stock, now's the time. Doesn't cost you anything.
To order Robert Half, I'm guessing.
Doesn't cost you anything. And I'm going to close the poll, and I'm going to share the results. And there are the results. Boy, I certainly hope I get a winner one of these days because I'm certainly dragging down our with all the audience here. Let's all cross our fingers for Robert Half in the next couple of months. Okay, guys?
We'll do that.
So that's what we'll add to the portfolio here. And I'm going to hide that now. And Mark, you can move on.
Okay. Well, as we collect up any questions you guys have, we did run a little bit longer, so we'll field a couple of questions, but stick around and deal with some Q&A. But just wanted to remind everybody that we are meeting on the final Tuesdays of July and August coming up. The next session will be a month from now for the July roundtable, and I'm sure Natalie will be out with registration details shortly on that. Other than that,
Mark, are you going to close the recording down now, and then we'll answer questions after?
Yeah, let's go ahead and do that. People less bashful, and just go ahead and sign off for us, Ken. Thanks everybody for your effort and contributions to tonight's session. We hope that you all enjoyed it.